Welcome to StockOdds Odds and End podcast. I'm Dave Singh here with Rob Friesen, getting ready for the week ahead. Good evening, Rob. How's everything?
Not too bad. Sorry to our listeners, we missed a couple of weeks there with busy schedules. But we're back at it, and I want to leave you hanging. We want to see if we can help. Just commenting on some things, wrapping things together. So we'll get started first by saying that there is no seasonality this coming week here because we're a little bit in a no man's land between the mid-month seasonality that culminated on expiration. I mean, there can be a little bit of runoff into the Monday, but let's just call it a wrap with, the third Friday of the month expiration. So this was quarterly expiration. And then we have to wait until, the last 5 days of the month for our next seasonality window that we look at, which is a full week. I mean, this month of March here is kind of structured really, really nicely. So we've got this no man's land week, and then we have the last 5 trading days of the month, all within the last week of the month. We take a look at, well, how did we arrive, at this expiration? And one of those influences was mid-month seasonality. And so mid-month seasonality shows the Qs to be pretty strong relative to the SPY. It actually shows the Qs to be strong, for the month relative to the SPY for the month of March. And that's what we've been seeing. Dave, haven't you noticed the strength in the technology stocks?
Yeah.
Especially the mega cap, right?
Correct, yeah. And
So,
especially the 2-year, with the drop in the 2-year, that's just supportive for tech in general. So,
we know that NASDAQ doesn't have the banking exposure that the S&P does. So that's also why it wasn't marching to the beat of the same drummer. The rally up on the Qs was quite good. And the worst of the 4 horsemen there is the IWM. The Russell 2000 has performed the worst recently. And that's kind of to be expected when you think about, what is the landscape for small caps? What's their behavior? What's their makeup? What's their DNA? Well, they have generally less liquidity across the board. They have more volatility. So combine those two together and you get a lot more, weird stuff going on. And then they like the prospects of growth, and even on a down day for the SPY or the, Qs in the past, often the small caps have rallied, but that's only because there is that backdrop of some growth. And we've kind of seen that be challenged in recent weeks, and especially with the banking crisis, because as you know, small companies need often working capital, need lines of credit, need financing, need to have an environment that is bank friendly and venture capital friendly, and both those areas have been affected. So this, what I don't like about I mentioned this before on the call here once before, and that is I really don't like the Russell long only against IWM all the time. I mean, it can work out some days, especially if you notice that the Russell is weakening, really encourage you to move towards beta hedging to offset your downside. And if you beta hedge, that's not a bad offset. And like Friday, you can end up positive on the list. But what's actually better is if you can, subscribe to the web screener and produce for yourself longs and shorts in the Russell. And we've kind of steered away from recommending shorts in the Russell only because sometimes you get the meme stuff, you get things that are takeover candidates. You get things that just go on a tear and go up 25 or 50% for a day. And so, we just kind of are concerned that people don't get run over, because theoretically the loss on the short side can be unlimited versus the loss on the downside is simply, a stock going to zero, right? So, but for yourself, we encourage you, if you want to play in the Russell, to, curate some longs and shorts, because the shorts really do pay off on those types of days where everything's heading down, and they do a lot better than just the single ETF like IWM. Would you agree with that observation and experience, Dave?
Yeah, I've seen that. Yeah, it's a lot less variance, and with the hedge at the IWM or TWM, you're either really, really good or really, really bad. But
Right.
it kind of levels things out a lot better when there are longs and shorts.
Well, and the shorts can often work for you really well. Like even with our 5-day swing trading list, which was curated last Friday or the Friday before, and it was for the open from Monday to the close of Friday, which was expiration. That 5-day list had 10 longs and 10 shorts. And it was actually the shorts that produced the market itself. From the open of Monday to the close of Friday was up 2.1% if we talk about the SPY. But the portfolio of longs and shorts mixed was up 2.5%. So it actually had alpha over the SPY. And it was really the shorts that did all the heavy lifting. They're the ones that made money, which, again, in an up market, shouldn't be that way. But it's just my encouragement to really find some strategic shorts. And, if you're in doubt and you only have the ETFs, well, that's fine. But make sure you pay a little more attention to how things are going so you can add some weight. You have to do this with any ETF that's more statistically muted. You have to add some weight to compensate for the higher beta, higher volatility, or just, the focused moves that some of the stocks can have. Okay. So Dave, we've got this Credit Suisse situation going on. You read the news. You want to comment on that?
Well, UBS initially had a really low bid to buy Credit Suisse, and they found it insulting, right? And they came back and got a little bit higher. But the overall thing is governments and larger institutions are kind of having this backstop here, right? They're coming in to shore up the system, right? Protect it for all, which is good news for in the immediate future for the situation. But again, it goes back to this bailout kind of mentality, which has been the backdrop for all these years, right? Printing
you never get out. You never get out of it, right? I mean, it's like a welfare system. When you start something, it's really tough to get off it, right?
So it's a band-aid, but short term, it's I thought that's where the futures are up a little bit too. It's showing that there is kind of this backstop to the financial industry and these banks.
Well, this Credit Suisse was much bigger deal than Lehman Brothers back in the day. I mean, so there is the UBS agreeing to buy it. Now, some of the riskier bondholders, like the A1 bonds, they're getting wiped out. So, in favor of the equity, which is not usually bondholders do better overall, but there is some hit there. But this is also being backstopped by, the Central Bank of Switzerland. So it's a big deal, and that reduces the competition and probably ultimately makes the situation more risky for, Swiss citizens and residents and so on in terms of their banking. But we're seeing the same thing, of course, throughout the U.S., regional banks specifically, and there may be more dominoes to fall yet before this is said and done. Because, what triggered the fall of the three that have collapsed, one was more related to crypto, one was more related to, just bad assets, and one was more related to holding U.S. treasuries at prices that ended up declining, and then of course the run on the bank just made it all that worse. So, but I don't think we're out of the woods altogether. We'll have to watch closely the bonds and closely the U.S. dollar for an indication of what's going on. Run through some of the economic news that's coming up this next week here, Dave.
Yeah. So on Tuesday we have existing home sales. Also on Thursday we have new home sales. So there's a bit of focus on how housing is doing. And then Thursday we have initial jobless claims, and Friday there's PMI. So give a little bit of sense of how the economy is doing in terms of services and manufacturing. But the key thing is going to be Wednesday. That's the federal interest rate decision and the federal Chair Powell press conference, right? So that's going to be the big mover in the week, and they're expected to do at least 25 basis points increase, and that's going to be the big focus of the week is that Wednesday conference call and the decision.
Right. We had originally expected 25, and then the future or the Fed CME forecast tool, ramped it up to 78% chance of a 50, and then of course with the banking crisis that dropped down to back to maybe there's 0%. Maybe we're not even going to have a hike, and then now it's sort of settled at 25, just because they've had a lot of flack about, well, now what are you going to listen to the public pressure and do a Fed pivot, or are you going to stick with the fight against inflation? So it's really a battleground, and probably 25 would be what they'll do, okay, because that's the odds are very high of that at the moment, and then possibly pause to then look at the data again and see how this banking thing is playing out, and then maybe they'll go back to skip a month and do another 25 and skip a month to do 25 or whatever. But there's a lot of parties that don't want to see them let up on inflation because it's a concern, and the problem is the more money they put into the system, the more the dollar is under pressure, ultimately the more inflation we could have anyway, right? So I just think it's a catch-22. What do you do? So
yeah.
Let's talk about the 1 week performance here, because we ended on expiration, and often there can be this change, a kind of a mean reversion or reversal after expiration. So I don't want to say that that's absolutely certain to happen. It's a high probability there can be that change. Being that, as Dave said, it's Fed week, there's a lot going on. It is a 2-day meeting, so there's the history of Fed meetings. What is the history of Fed meetings? We tend to rally sometimes on the Monday or the Tuesday before, and then maybe decline a little bit, and then have a bit of a rally before the announcement itself. So, and then afterwards, well, who knows how the market's going to take the Q&A period and what's said and so on. But there is often a little bit of a rally in Fed announcement weeks. So keep that in mind. But let's look at how we got here. Communication services had an incredible week, up 6.85%. Technology also up 4.99%. So, Apple, Microsoft, Meta, Google, some of the stocks that really shined in the technology and also communication area. Utilities were up 3.9%. So that reflected a little bit of a defensive posturing there. And sometimes when rates are coming down, the better dividend yields on utilities shine, and when rates are going up, sometimes they're despised and people go to cash. So there's that tension. Healthcare up 1.42, consumer cyclical 1.15, consumer defensive 0.73. So a little bit of some defensive stocks were doing okay, but there was a lot that were sold. You can see that based on your performance with the Dow 30. I mean, that thing's been in a bit of a channel all week, didn't have the rally that the NASDAQ had at all, right? So kind of went NASDAQ, then SPY, or then S&P 500, and then the Dow, and then the Russell was the worst. Real estate was down 0.71. Again, this is this interest rate thing. Industrials down 2.43. Basic materials down 2.51. Financials down 4.83. Obviously expected with such a chaos going in the banks and other financials as well. And energy, you know, it just looks like it's factoring in a massive recession, down 7.62. So that's what's screaming out at us with oil. Plus, it's also based on, you know, production metrics and cuts or lack thereof. Or there was also announcements of other projects coming online. So that's what we had for the week. So I want you to watch closely at any continuation of these or any reversal or possibly mean reversion. Maybe energy has a bit of a bounce. Maybe financials are a little bit stronger after the Credit Suisse announcement. Maybe the dollar pulls back and the basic materials rally a bit. Okay. What else is on your list there, Dave?
There's a couple earnings. We got Nike on Tuesday, Foot Locker on Monday, some solar stocks, Canadian Solar Wednesday. Let's see, we got KB Homes. So some housing related things again, and then also Petco, Chewy.
Okay. I'll just run through the futures, what they're doing now since we've been open for almost 2.5 hours. So Dow Jones futures are up 41 points or 0.13%. Again, we got just a massive channel it's stuck in, and it's just sitting right in the middle of it. So who knows, just more of the same maybe. S&P 500 has a bit of a slope to its channel, got stuck around that 4,000 level. It's up 9.75 or 0.25%. NASDAQ, again, I mentioned it had done the best, and it's up 0.27%, up 34 points right now. And it's kind of sitting on kind of a ledge right now after the rally that it had last week. So Friday was a bit of a pause and rest, kind of pullback day, but on Friday it did also make a higher high than Thursday. But it's just sitting here almost like a bit of a teeter-totter. Russell down in the dumps. We got a significant support level that it's really close to. And so just look at your 5-day lows on that. That's going to give you an indication of that. But right now it is up 0.54% or 9.4 points. I might offer that, you know, this might be the most attractive bounce back area, right? Like if you're looking for something that might actually pop up, it's possible. It all depends on how this carries over into tomorrow morning with the performance that it has now, which is better than the other markets. Keep an eye on the VIX. It's been really, crazy. Not the highest it's ever been, but it's been just really violently moving between 23 on the VIX and 28. So it is elevated, and it's quite snaky there. So it's down currently 1.3%. So again, for the potential for a little bit of a lift here before the FOMC announcement, we're seeing some signs of that already. And that might carry over all the way into the announcement. So US dollar, it is currently up just slightly, 0.14, but it's in a real 5-day channel as well. And it's kind of sitting a bit on a ledge itself. So hopefully that helps. I think we covered it okay. Anything else that I forgot?
No, that's it from my end too.
Okay. I saw one thing that was I guess it's all right. Just let me look at the bonds here before we go. So bonds are currently down 0.4%. That's the 30-year, the 10-year 0.35% down. And then Dave pointed out the 2 years just down slightly. But all of them have had, obviously incredible rallies in the last week and a half. So, that bonds prices go up and rates come down. So with the unrealized losses that are affecting the banks, if the bond prices were to continue to move higher, that would certainly help alleviate their longer duration stuff. But it also depends on confidence of consumers and depositors and so on. And so it's not going to be easy, even if rates drop more and the bonds rally. It's going to take some pressure off, but it won't be that easy just because of how far and how fast we actually moved. When you look at the weekly, the 10-year note, for example, was trading at 140 between 2020 and 2021. And then from there, we dropped all the way down to 110, in a year and a half. And I just think that so many of these banks got themselves stuck in something that's a safe haven, became a toxic asset, actually. All right. With that, we'll close her off. Thanks, Dave, for your time.
All right. Good luck. Thanks.